Most people think the hardest part of investing is picking the right ETF. You spend hours reading comparisons, watching videos, reading Reddit threads, and eventually you land on something that feels right, and then you buy it, and then you wait. And somewhere in that waiting, maybe 6 months in, maybe 2 years in, something unexpected happens. Not a crash necessarily, just a slow creep of dissatisfaction. The account is doing what it was supposed to do, and somehow it is not doing what you needed it to do. The dividends are smaller than you expected, or the account value is growing but nothing is hitting your bank account, or it is paying well but barely moving in value, and you feel like you are falling behind. That disconnect between what an ETF does on paper and what it actually feels like to live with is where expectations break. And nobody talks about it enough. Today, I am going to show you exactly what $500,000 looks like inside 5 very different ETFs over the same 5-year period, not in broad strokes, but year by year, number by number. You will see what the account value looks like at the end of each year. You will see how much income arrives. You will feel the difference between a portfolio that is growing quietly in the background and one that is depositing real cash into your life every single month. I will show you one ETF that ends up paying over $76,000 a year in dividends by year 5, and another that turns the same $500,000 into over $1.28 million, with almost no income along the way. And then at the end I will show you the combined portfolio built from all 5 that turns $500,000 into nearly $900,000 while generating around $33,000 a year in dividends by year 5. The goal is not to pick a winner. The goal is to show you exactly what each path costs, what each path pays, and which one lines up with what you actually want your money to do. Before I run any numbers, I want to spend a moment on why the same $500,000 can end up in such dramatically different places 5 years from now depending purely on which ETF holds it. The answer is not luck, and it is not market timing. It is design. Every ETF has a specific design philosophy, a set of deliberate choices about what kinds of companies to own, how to weight them, and what outcome to optimize for. Those design choices produce different income streams, different growth trajectories, and different experiences during both good and bad markets. Matching the design to what you actually need is the whole game. And the 5 ETFs we are about to look at represent 5 genuinely different design philosophies, each one doing something specific exceptionally well and something else less well as a direct result. Let's work through them one by one. The first ETF is VOO, the Vanguard S&P 500 ETF. If you have spent any time in the personal finance space online, you have encountered VOO. It is the most widely held ETF in the world by many measures, managing approximately $1.5 trillion in assets. It tracks the S&P 500 index, which means it owns approximately 500 to 505 of the largest publicly traded companies in the United States, weighted by market capitalization. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta. The biggest names carry the biggest weight. The expense ratio is 0.03%, essentially free. There is no stock selection, no market timing, no active management. VOO simply owns the American economy's largest companies and lets time do the work. The metrics explain exactly what to expect. The dividend yield sits around 1.11 to 1.13%, so income is present but modest. Dividend growth has averaged approximately 6% annually over the past decade. The real story with VOO is price appreciation, which has averaged approximately 13.3 to 13.9% annually over the long term. Almost all of the return comes from your shares becoming more valuable. The dividends exist, but they're quiet. Now, let's see what that means for $500,000 over 5 years. At the end of year 1, the portfolio is projected to be worth approximately $572,100. Year 2 pushes it to approximately $654,135. By year 3 it reaches roughly $747,244. Year 4 comes in at approximately $853,544. And by the end of year 5, the VOO portfolio is sitting at approximately $974,156, nearly doubling the original investment in 5 years without adding a single additional dollar and without making a single trade. That trajectory is the case for VOO in simple, undeniable form. The account grows significantly, the direction over time is consistently upward. But here is the income story, and this is what many VOO investors underestimate when they first buy in. In year 1, dividends total approximately $5,950, about $463 per month. Year 2, approximately $5,889. Year 3, approximately $6,244. Year 4, approximately $6,615. And by year 5, annual dividends are approximately $7,250, roughly $588 per month. Nothing is broken here. VOO is doing exactly what it is designed to do. Growth is locked inside the account, compounding quietly. But if you expected your $500,000 investment to generate meaningful spendable income, the $463 a month landing in year 1 is a genuine shock. This is the expectation gap. VOO is a wealth accumulation tool, not an income tool. Understanding that from the start is the difference between a satisfying experience and a frustrating one. The second ETF is VEXUS, the Vanguard Total International Stock ETF. Where VOO covers the United States, VXUS covers everything else. Thousands of companies across Europe, Asia, Latin America, and other developed and emerging markets around the world. Names like Nestlé, Toyota, ASML, Samsung, Roche, and HSBC sit inside VXUS alongside thousands of smaller international companies. The fund is market-weighted, passively managed, and carries an expense ratio of 0.08%. It is as cheap and broad as international exposure gets. The reason investors add VXUS is not to chase faster growth than the US market delivers. Over the last 15 years, US stocks have significantly outperformed international stocks, and VXUS does not change that historical reality. The reason to own VXUS is twofold: geographic diversification that protects against US-specific risks, and meaningfully higher dividend income, because international companies in Europe and Asia generally pay higher dividends as a proportion of their earnings than American companies do. The metrics bear this out. VXUS carries a dividend yield of approximately 2.96%, almost 3 times VOO's yield. Dividend growth has averaged approximately 6.5% per year. Price appreciation has averaged approximately 6.5% annually, meaningfully lower than VOO's pace. Less speed, more balance and income. For $500,000 in VXUS over 5 years, year 1 ends at approximately $547,590. Year 2 reaches roughly $599,536. Year 3 pushes to approximately $656,512. Year 4 comes in at around $718,990. And by the end of year 5, the VXUS portfolio sits at approximately $787,242. That ending number is noticeably lower than VOO's $974,156, and that is usually where most people stop the comparison. But the income side changes the picture significantly. In year 1, VXUS pays approximately $15,500 in dividends, about $1,220.92 per month. Year 2, approximately $16,485. Year 3, approximately $18,766. Year 4, approximately $19,778. And by year 5, annual dividends are approximately $21,764, roughly $1,805 per month. You're receiving more than 3 times the monthly income of VOO while accepting lower capital appreciation. The trade-off is explicit and consistent. VXUS gives you income much earlier and more substantially than VOO in exchange for slower account growth. Whether that trade-off is worth making depends entirely on whether that income matters to you right now. The third ETF is SCHD, the Schwab US Dividend Equity ETF. If VOO is about owning the whole American market and VXUS is about owning the whole international market, SCHD is about owning a specifically selected group of around 100 American companies that have proven their ability to pay and grow dividends over time. To be included in SCHD, a company needs 10 consecutive years of dividend payments and must score well on 4 specific financial metrics: cash flow to total debt, return on equity, dividend yield relative to peers, and 5-year dividend growth rate. That process creates a portfolio dominated by defensive, cash-generative businesses, consumer staples, healthcare, energy, and financials, rather than the technology-heavy composition of VOO. SCHD's current dividend yield is approximately 3.5 to 3.8%, meaningfully above both VOO and VXUS. But the number that makes SCHD stand out from everything else we have looked at is the dividend growth rate, approximately 10 to 11% per year over the past decade. That is the mechanism that makes SCHD such a powerful long-term income compounder. A dividend that grows at 10% per year doubles every 7 years. Combined with reinvested dividends buying more shares, the income snowball effect in SCHD over 5, 10, or 20 years is one of the most compelling stories in ETF investing. The price appreciation averages approximately 9% per year. Solid, but not explosive. SCHD is genuinely trying to do both, grow your account and grow your income, reasonably well simultaneously. For $500,000 in SCHD over 5 years, year 1 ends at approximately $562,751. Year 2 reaches approximately $633,687. Year 3 pushes to approximately $713,919. Year 4 comes in around $804,116. And by the end of year 5, the SCHD portfolio sits at approximately $907,525. That growth significantly outpaces VXS, and the income story is stronger too. In year 1, SCHD pays approximately $17,550 in dividends, about $1,463 per month. Year 2, approximately $20,063. Year 3, approximately $22,946. Year 4, approximately $26,257. And by year 5, annual dividends reach approximately $30,061 on roughly $2,505 per month. SCHD starts with higher income than VXS, grows it faster, and delivers better capital appreciation along the way. The trade-off versus VOO is the lower total account value at year 5, approximately $67,000 less, in exchange for receiving roughly $30,000 per year in income compared to VOO's roughly $7,050. Whether that income difference justifies the slightly lower ending balance depends on whether you need that cash flow or plan to reinvest it. The fourth ETF is JEPI, the JP Morgan Equity Premium Income ETF. And this is where the income conversation becomes a completely different order of magnitude. JEPI holds a diversified portfolio of U.S. large-cap stocks and overlays an equity-linked notes strategy, essentially selling call options on the S&P 500 index, to generate additional monthly income on top of the stock dividends. That options premium income is the mechanism that allows GP to pay yields that simple equity funds simply cannot match. The expense ratio is 0.35%, higher than the passive index funds we have looked at, which reflects the active options management required. But JEPI is not trying to compete with VOO on cost or growth. It is trying to pay you as much income as possible every single month. The metrics make JEPI's priorities unmistakable. The current dividend yield is approximately 7.5 to 8%. Distribution growth has averaged approximately 7 to 8% per year, as both the underlying equity dividends and the options premiums have grown over time. Price appreciation has been modest, approximately 5 to 3% per year, because selling covered calls caps the fund's upside participation in strong market rallies. When the S&P 500 surges, JEPI participates only partially because the options it has sold limit how much of that upside the fund captures. The design trade-off is explicit and deliberate. You are accepting significantly lower capital appreciation in exchange for monthly income that arrives whether the market is up, down, or sideways. For $500,000 in JEPI over 5 years, year 1 ends at approximately $553,490. Year 2 reaches approximately $615,410. Year 3 pushes to approximately $686,172. Year 4 comes in around $768,740. And by the end of year 5, the JEPI portfolio sits at approximately $865,300. That ending balance is the lowest of any growth-inclusive fund we have reviewed, but the income side is where JEPI operates in a completely different league. In year 1, JEPI pays approximately $40,300 in dividends, but about $3,358 per month. Year 2, approximately $46,950. Year 3, approximately $54,960. On year 4, it's approximately $64,467. And by year 5, annual dividends reach approximately $76,100, roughly $6,340 per month. More than $6,000 a month in passive income from a single ETF. That number changes what retirement or financial independence can look like for a lot of people. The account grows slowly, the income grows quickly. And if your financial plan requires cash flow rather than capital accumulation, JEPI's income delivery is genuinely transformational compared to anything else on this list. The fifth and final individual ETF is VGT, the Vanguard Information Technology ETF. Everything we have looked at so far has tried to balance growth and income in some proportion. VGT throws that balance away entirely. It owns U.S. technology companies almost exclusively: software, hardware, semiconductors, cloud infrastructure, enterprise technology. Apple and Nvidia together represent approximately 35 to 40% of the fund. Microsoft adds another significant chunk. The expense ratio is low at 0.10%, but the real risk in VGT is not fees, it is concentration. When technology does well, VGT does exceptionally well. When technology sells off, VGT takes the full force of that sell-off with no defensive holdings to cushion it. In 2022, VGT fell roughly 33%. The investors who held through that drawdown and bought more were rewarded. The investors who sold near the bottom experienced that concentration as a loss rather than a temporary setback. The income from VGT is essentially negligible. The dividend yield is approximately 0.41%. On $500,000 that generates about $2,050 per year, roughly $171 per month. Technology companies reinvest their earnings into growth, rather than distributing them as dividends, which is part of why their share prices appreciate so dramatically. The price appreciation over the past decade has averaged approximately 20 to 21% annually, the highest of any major ETF sector in that period. And over a 5-year window, that rate of appreciation is stunning in its results. For $500,000 in VGT over 5 years, year 1 ends at approximately $604,500. Year 2 reaches approximately $729,320. Year 3 pushes to approximately $830. Year 4 comes in around $61,640. And by the end of year 5, the VGT portfolio sits at approximately $1,281,137, more than doubling the original $500,000 in 5 years. That is the strongest capital growth result on this list by a considerable margin. The income? In year 1, VGT pays approximately $2,050. It barely grows because dividend yield shrinks as the share price rises faster than the dividend. By year 5, annual dividends are approximately $1,860, declining slightly despite the massive portfolio growth, roughly $155 per month. VGT is the extreme version of the growth-only trade: maximum capital appreciation, minimum income, maximum volatility, zero defensive characteristics. For investors with a long time horizon, genuine comfort with 30+% drawdowns, and no need for income from this position, VGT's 5-year trajectory is the most powerful on this list. Now let me show you what happens when you stop trying to pick one approach and build a structure that deliberately combines all 5. Because the most important insight from looking at these funds individually is that each one does something the others do not. VOO gives you the broadest, most liquid U.S. market exposure at the lowest possible cost. VXUS adds international diversification and higher immediate income. SCHD grows income powerfully over time, while still delivering solid capital appreciation. JEPI maximizes current monthly cash flow for investors who need income right now, and VGT provides a concentrated technology growth engine for the portion of the portfolio where maximum long-term appreciation is the goal. None of them alone is the right answer for most investors. Together, properly weighted, they become something more useful than any individual component. Here is the combined portfolio allocation for the full $500,000. JEPI receives 30% of the allocation, $150,000. Serving as the income anchor, the piece that generates the most cash flow and stabilizes the monthly distributions. SCHD receives 30%, another $150,000, serving as the income growth engine, the piece that ensures the distributions compound faster every year. VXUS receives 20%, $100,000, adding international diversification and additional dividend income from non-US markets. VOO receives 10%, $50,000, keeping steady broad U.S. market exposure and the long-term growth discipline that index investing delivers. And VGT receives the final 10%, $50,000. As the concentrated technology growth kicker, the piece that adds extra upside potential when the tech sector performs. The blended metrics of this combined portfolio are what make it compelling. The combined dividend yield is approximately 4.23%, high enough to generate meaningful income from day one without forcing yield at the expense of everything else. The blended dividend growth rate is approximately 7.6% per year, so the income compounds meaningfully over time rather than staying flat. And the blended annual price appreciation is approximately 8.2% per year, keeping the portfolio growing at a solid pace, even as significant capital is directed toward income. Here is what the combined portfolio does to $500,000 over 5 years. Year 1 ends at approximately $561,994. Year 2 reaches approximately $631,546. Year 3 pushes to approximately $709,561. Year 4 comes in around $797,520. And by the end of year 5, the combined portfolio sits at approximately $895,152. That ending balance beats VX's and JEPI individually. It sits between SCHD and VOO. It does not beat VGT, and it is not trying to. The goal of the combined portfolio is not to win the growth race, it is to grow meaningfully while also paying you consistently throughout the journey. The income story of the combined portfolio is where the real value of the structure becomes clear. In year 1, the combined portfolio generates approximately $21,125 in dividends, roughly $1,760 per month. Year 2, approximately $23,615. Year 3, approximately $26,294. Year 4, approximately $29,493. And by year 5, annual dividends reach approximately $32,950, roughly $2,746 per month. Nearly $2,750 a month in passive income from a $500,000 portfolio, while the account value has simultaneously grown from $500,000 to $895,252. You are receiving meaningful income every month and watching your balance grow toward $900,000 at the same time. Neither the income nor the growth is the best available in isolation, but the combination of both, growing account, growing income, is what most investors actually need their money to do. Let me put all 5 individual results and the combined portfolio side by side at the year 5 mark so you can see the full picture clearly. VOO, $974,156 in portfolio value, $7,050 in annual dividends, $588 per month, the purest capital growth option on the list. VXS, $787,242 in portfolio value, $21,664 in annual dividends, $1,850 per month. Slower growth, meaningful income, broad international diversification. SCHD, $907,025 in portfolio value, $30,061 in annual dividends, $2,505 per month. Solid growth, strong income growth, quality U.S. dividend companies. JEPI, $865,300 in portfolio value, $76,100 in annual dividends, $6,342 per month. The income maximizer, the fund that pays you most generously every month in exchange for the slowest capital appreciation. VGT, $1,280,137 in portfolio value, $1,960 in annual dividends, $155 per month. The growth maximizer, the fund that builds the most wealth in the shortest time with essentially no income and the highest volatility. And the combined portfolio, $895,000 in portfolio value, $32,950 in annual dividends, $2,746 per month. Solid growth that approaches $900,000, meaningful income that reaches almost $33,000 per year, and the structural resilience of having 5 different approaches working simultaneously. The decision about which of these paths makes sense for you comes down to 3 honest questions. How much income do you need from this money right now? If the answer is none, you are accumulating and will not need distributions for many years. VO or VGT are the more powerful wealth builders. If the answer is a lot, you are close to or in retirement and need cash flow to cover living expenses. JEPI's $6,242 per month at year 5 is in a completely different category from everything else. If the answer is somewhere in the middle, you want income growing over time while the account also grows. SCHD or the combined portfolio are the most coherent options for that goal. How much volatility can you actually hold through? VGT dropping 33% in a single year is not a hypothetical. It happened in 2022. If you would have sold near the bottom, the superior 5-year return I showed you would not be yours. You would have crystallized a loss and missed the recovery. Honest self-assessment on this point is more valuable than any projected return number. And finally, what stage of wealth building are you in? Early accumulation, where you have 30 years before you need the money, strongly favors the high growth, low income options. Approaching retirement, where the portfolio needs to fund your life within a decade, strongly favors the income-heavy options. The same fund that is the right answer at 30 is often the wrong answer at 60. There is no universally correct choice here. There is only the choice that is most aligned with your specific situation, your specific need for income, and your specific temperament when markets are difficult. What I hope this exercise has made clear is that the returns you see advertised for any ETF are only part of the story. The other part, what it actually feels like to live with that ETF, what it puts in your pocket each month, and whether that experience matches what you needed when you started, is equally important and far less discussed. Now you have both parts of the picture. If this breakdown was useful, hit the like button and subscribe. New content on portfolio construction, ETF comparisons, and long-term wealth strategy goes up regularly. Drop a comment below and tell me which of these 5 approaches is most aligned with your current situation. I read every single comment. I will see you in the next one.